Warren Buffett 12. Investing mistakes. Number 6. Jumping over 7-foot bars. I think committing this mistake is so common because it completely goes against what success means in many other endeavors of life. Climbing impossible mountains, jumping impossible heights, solving impossible equations, you name it. Everywhere else you are rewarded for during difficult stuff. But in the investment world, it just isn't so. During complicated mathematical acrobatics or difficult prediction about the future of industries is not only rewarding but often disastrous for investment results. Long-term capital management. Simple ideas yield expectational results in the long run in the investment world. Number 7. Shrinking your universe of opportunities. I have been fishing for most of my life because my father is a great fishing enthusiast. One of things that I have noticed my father doing is that he is never spend too much time in the same place. If it does not yield any fish, he moves on to another spot. Had he been stubborn or narrow-minded, trying to fish in the same spot all day, the same hold true for investing. Opportunities do not stay in the same place for too long, and one never knows where they will shows up next. My funds do this by, for example, only focusing on ESG types of companies, only focusing on high dividend paying companies, only focusing Swedish companies, only focusing what you have you. Opportunities do not work like that. I considers naming it the gaming investor instead of the Swedish investor, because for a moment I was thinking about only focusing or companies in the gaming industries. There is a difference between staying within your circle of competence and being small-minded. Opportunities can pop up anywhere to where people think they can't possibly be because it's people who decided the price of stocks. Number 8. Staying active all the time. Who do you think is most likely to succeed? The tennis player who plays 5 games a day, or the one that plays 5 games per year? The author who writes 5 times per week, or the one that writes 5 times per year? The investor who buys 5 stocks per year, or the one that buys 5 per year? Investing one of those rare expectations where inaction rewarded. You can buy the equivalent of a Coca-Cola at a fair price every day. It just does not work like that. There are extensive bears market where opportunities are plentiful, and there are bull market where opportunities cannot be found no matter how many rocks you turns. Buffett say that an investor must behave like a baseball player who cannot possibly strike out. You don't swing at every ball that is thrown at you. That is just for a recipe for some really awful misses. So wait for pitch number 9, diversifying too much. I have discussed this on multiple occasions already, so I will be quite short here and point to you to this other video if you want to go more in depth on this topic. It basically boils down on this. If you are not willing to read up on individuals' companies on a regular basis, you should diversify. But if you are what Buffett call a know-something investor, something who enjoys staying up to date with specifically business and industries, you should leverage this knowledge to achieve above market's returns. If you buy the 30 largest companies of the S&P 500, when I was younger, there was some who thought that mixing 40% liquor with 30% liquor must make the resulting cocktail even stronger, maybe 70%. This is course silly. Adding anything weaker than 40% to 40%, one will only dilute the result. I currently own 10 stock myself, and I think that investor will forever debate what the perfect number is. Number 10 is confirmation bias. Charlie Munger has an analogy about this that I think it is quite funny. As an investor, this is a very costly mistake to make. We loathe to interpret and seek out new information when what we should be doing is the exact opposite. But I think I found to antidote the darling killing funnel and the bear pills. Say that I have to decide to keep 10 companies in your portfolio. They should have at least 20 candidates before you decided on which 10 keep. If you are taking the bear pills you are committed to before adding any company to your portfolio, making a very intentional choice to seek out the potential pitfall of that investment, or maybe hire a friends who willing to play devil's advocate. Number 11, following the herd. Just look like the mistake of jumping over 7-foot bars and staying active all times. In many things life, it's play to listen to the crowd. If your parents and friend like your girlfriend, she probably a pretty good partner. If a lot of people like particularly movies, chances are higher that you will enjoy it too. If people are really jealous about your career, it means you are probably doing pretty good for yourself, unless there is something that you are not to. Telling them, of course. In fact, your parents and all friend agree for the most recent stock that you recommended. It probably means that you should not buy it. As another excellent investor, Howard Marks put it, what's cleared the board? Sure, Tesla may take over the automotive industry, but it's not for going to good investment. It's if already priced as high as the whole automotive industries. This is my biggest mistake so far. I put quite a bit of money in a small startup that a friend had gotten rich investing in. The company was not in my circle of competence, but I throw hard-earned money after it nonetheless. And I also know that involved the company. I am just drum lucky. Number 12. Omission, however. As Buffett point out, sometimes the biggest mistake of all is not to do something. Not asking that girl that you are interested in is if she wants to go on a date with you. Never taking a risk in your career, or as in Buffett's case, not investing in something that was given. Buffett has often mentioned that this happened to him with Walmart. He was acquiring stake in the company. I think is the early 90s, but the price of the shares run away a little. If you think that a company is a great opportunity, X, it's probably good a opportunity. At one point, one ex-Buffett has said that this mistake cost Berkshire Hathaway's about $8 billion would be profits. He nearly made his same mistake with one of this greatest investment of all time, sea candies. Of course, hindsight is always 20/20, but when something is within your circle of competence and you identify it as an opportunity, you don't just stand there or nibble at it. These are the 12 deadly sins of investing.